the preeminent buyers of gold in the last 3.5 years haven't, in fact, been Americans concerned about the deterioration of their savings, but rather foreign governments who object to two things: the weaponization of the US dollar and the weaponization of the SWIFT banking system, which is to say the US government's attempt to use the US dollar to enforce its policy prerogatives elsewhere. Other countries object to that. And two, a return to that arithmetic. If you're China and you have $3 trillion in US treasuries, and you look at being paid 4.5% in a currency where the purchasing power is declining by 7.5%, it seems like a lousy deal, particularly when that's compared and contrasted with selling your US treasuries and using the money to make investments in your own economy. The Chinese, of course, have done both, made investments in their own economy and bought gold. And I think what you're seeing there is the hegemony of the US dollar challenged, often in favor of gold. One final piece of arithmetic, Julia, which we talked about 3 months ago, but some of your listeners won't have had the good sense to listen to us 3 months ago.
Imagine losing 3% of your purchasing power every single year. Rick Rule warns that holding cash in the US right now is a silent wealth destroyer. The Consumer Price Index claims inflation is only 2.6%, but if you've seen your rent, groceries, or healthcare bills, you know the real number feels closer to 7.5%. That means even the so-called risk-free 10-year treasury at 4.5% is actually costing you money. Rule explains why this environment is pushing smart investors and even foreign governments toward gold as the ultimate hedge against a system designed to erode your savings.
I need to say that the U.S. economy is an economy that increasingly works for people like me, and not so much for other people. An economy that has been exposed to globalization so that people who don't have the skills to compete on a global level are seeing their real standards of living deteriorate. An economy, too, in the United States where artificially low interest rates, penalize savers, reducing the amount of money that they get on their savings while subsidizing investors like myself, people who have access to credit and the education as to how to use it. So I understand that one of the problems with our economy, and in fact the global economy, is that a whole bunch of people aren't participating. That notwithstanding, a whole bunch of people, investors and people with access to credit, are. And I am still surprised by the relative strength. I do note that there are some warning signs in the economy, and those warning signs are more pronounced they were than the last time that you and I spoke. One example would be in the U.S., where the Fed has reduced the short-term interest rate, but the market hasn't listened. The yield on the long bond has gone up. I've seen this happen 4 times before in my career. And these weren't the promises of good times ahead. This is the investor saying, irrespective of where the short-term rates are, inflation is rearing its ugly head. And the idea that I'm going to be contented with a 4% yield some years out, given the fact that the rate of deterioration of the purchasing power of the US dollar is increasing, the probability of that is nil. That's not a good sign. When the Fed loses control of the long yield, when the market reasserts control of the long yield, that's often a harbinger of more challenging times to come. 2, when you look at the U.S. stock market, which, if you only look at the indexes, shows some signs of strength, that ignores breadth. Most of the breadth in the S&P 500 is comprised of 10 or 12 stocks, the sort of Nvidias of the world. And when you look at the breadth in the rest of the equities market, one becomes challenged. The flip side of that, and I know you want a definitive conclusion, which I don't have. The flip side of that is that the equities market isn't as overpriced as one thinks it is. Value stocks, community bank stocks, small cap stocks, out of favor stocks are, if you use the metric earnings or cash flow relative to enterprise value, not as expensive as the S&P 500 looks. And in that sense, maybe we will ultimately get broader breadth. Or if we have a circumstance where major equity markets decline, maybe you'll see a circumstance where the out of favor stocks in today's market decline by less than the glamour stocks going forward. Notice, of course, by the way, Julia, that I hedge my bets by saying maybe.
Yeah.
The truth is, when you're looking at the future, you're talking about a range of probability. We suggested in our prior interview that the stage was set for a higher gold price.
Mhm.
And surprisingly, we got that right too. Yeah, the arithmetic is ugly. I mean, if you're thinking about the arithmetic in the context of why the gold price is rising, gold prices usually rise when people are concerned about the maintenance of purchasing power in fiat currency denominated savings instruments. On a global basis, the world's reserve currency is the US, and by default, the world's preeminent savings instrument is the US 10-year Treasury. So let's look at the arithmetic just around the Treasury. The first thing to say is that the current deterioration of the purchasing power of the US dollars is measured conventionally by something called the CPI, the Consumer Price Index. And I would argue with you that the CPI is a very inefficient measure of the deterioration of the purchasing power of the US dollar. If you believe the CPI, it would suggest that the deterioration, Julia, of your savings is progressing along at about 2.6% per annum. I think if you examined your own personal finances in the period, say 2000 to 2025, a 5-year period, and you thought about how your health insurance premiums had changed, or how the price of your groceries had changed, or how, if you're a homeowner, mortgage interest rates have doubled, or if you're a renter, what has happened to your rents? When I run that same exercise myself, and by the way, I'm an old cheapskate who doesn't spend very much, I find that a deterioration of my purchasing power is more like 7.5% per annum than it is 2.6% per annum.
Mm-hmm.
I would urge your listeners to think about their own spending patterns and whether 2.6 represents the level of the deterioration of the purchasing power of their savings that they've experienced. If you use the CPI number, the arithmetic around the US 10-year Treasury isn't bad. You're getting paid 4.5% a year in a currency where your purchasing power is declining by 2.6%, which means you're getting almost 2% real yield. If by contrast you use the 7.5% number, that is, you're getting paid 4.5 in a currency that's depreciating by 7.5, you're losing 3% a year. The concept of investing in a riskless asset, a US 10-year Treasury, where your purchasing power declines by 3% a year, compounded over 10 years, is not very attractive.
Mm-hmm.
Let me restate that. It's extremely unattractive. And this is precisely the circumstance where gold does well.
Yeah.
And gold has done well.
Yes.
The second part of gold isn't so much arithmetic as narrative, which is to say the preeminent buyers of gold in the last 3.5 years haven't in fact been Americans concerned about the deterioration of their savings, but rather foreign governments who object to two things: the weaponization of the US dollar and the weaponization of the SWIFT banking system, which is to say the US government's attempt to use the US dollar to enforce its policy prerogatives elsewhere. Other countries object to that. And two, a return to that arithmetic. If you're China and you have $3 trillion in US treasuries, and you look at being paid 4.5% in a currency where the purchasing power is declining by 7.5%, it seems like a lousy deal, particularly when that's compared and contrasted with selling your US treasuries and using the money to make investments in your own economy. The Chinese, of course, have done both, made investments in their own economy and bought gold. And I think what you're seeing there is the hegemony of the US dollar challenged, often in favor of gold. One final piece of arithmetic, Julia, which we talked about 3 months ago, but some of your listeners won't have had the good sense to listen to us 3 months ago. That is this: gold is really, really, really underowned historically. JP Morgan Chase suggests that the market share of precious metals and precious metals related securities is less than 0.5% of total savings and investment assets. in the United States. In other words, an infinitesimal market share. The 4-decade mean market share is estimated by JP Morgan Chase to be 2%. So gold doesn't have to win the war against the US dollar. Gold doesn't have to demolish the treasury markets like some gold bugs suggest. All it needs to do is return to mean. If it returns to mean, demand for this asset class increases fourfold. One can only guess what a fourfold increase in demand would do to a commodity where increases in supply are extremely limited. And that's precisely what I think is going to happen and continue to happen. In that period, 1970 to 1980, back to arithmetic, according to the Office of Management and Budget, the US dollar lost in excess of 75% of its purchasing power, which is to say, at the beginning of the decade, what was $1,000 worth of goods and services, by the end of the decade would have cost you $4,000 to buy. During that period, the gold price went from $35, admittedly a price-controlled $35, to $850. And I think passes prologue. I don't see any reason, any way, with the on-balance sheet liabilities of the U.S. government at $36 trillion, and with the government's estimate of the net present value of off-balance sheet liabilities, mostly entitlements, Medicare, Medicaid, Social Security, exceeding $100 trillion, that is to say, with net government debt over $130 trillion, I don't see any way out of this circumstance other than inflating away the net present value of those obligations, just like the decade of the 70s. And that means likely not merely higher, but much higher gold prices.